appreciate the opportunity to be here and share a paper with you. We've got some work. We've been working on this for a little while, a couple of years, and it goes by slowly. The paper on SSRN that was made available is being revised again. I'll point out that we're learning about this in real time. Roger Smelzer from the National Conference of Insurance Guarantee Funds got in touch with me yesterday and again this morning with a few comments that that some of our details may not be exactly right. Also, my friend Smitty Harrison at the South Carolina Insurance Guarantee Fund. So there's a few things. The presentation, I believe, is as close to correct as we can get today, but you'll see a few differences between it and the paper that's on SSRN. Also, I'll say this is not just a working paper, but it's probably like a blue collar working paper compared to some of the others. We work pretty hard and do some things that were kind of an adventure to code, but not quite the same cutting edge things that we've seen some of the papers. But nonetheless, I think we come up with some interesting and perhaps even useful information for policymakers. This started out as a paper about COVID. I won't go too much into the background. It became more about climate change when people became more interested in that. We started out trying to see how much of the COVID loss of income peril that could be insured. And the answer was, well, not very much. Climate change is always a fun thing to research from Alabama, where we don't have that legislatively. But I love coming up here to New York City to tell y'all about climate change. That's even if we don't have it, we can still study it. But it's also shows up in some of the demographic shifts that we see and where people live and where people choose to build their homes. There's a lot of decisions people make that can lead to insurance being really expensive and having really large losses. In fact, really, this paper is about seeing something that we haven't seen before. I didn't read this article, but I saw it and really liked the title and the description recently. I think this was in Nature, saying that we don't really know where we are in terms of modeling climate. We don't know what's going to happen even in the near-term future. So I asked a AI image generator, show me what it looks like if a EF5 tornado came here. You may be aware that in 2011, on April 27th, an EF4 tornado dug about a mile-wide ditch from Tuscaloosa to Birmingham. And that's still the most expensive tornado on record for insured losses at $8 billion, and 253 people died. I don't know if you've visited Tuscaloosa before, but there's not a lot there. There's not a lot to hit. It missed the entire university, even though it came very, very close. But I was thinking of what's something that could happen. It would be $1 trillion loss. And there's been 2 EF2 tornadoes in New York City in the last 20 years, one on Long Island, the other in Brooklyn. At least that's what the data shows. They weren't big things in the news that I recall. But some of the folks in our engineering department say the difference between an EF2 tornado and an EF4 or 5 is lightning striking in just the right place to turn it into an electromagnetic field, which I'll take my tinfoil hat off and go back to things I know about. But just thinking, if that could happen, that's a really big loss. We can look at large losses that have already happened. These are some of the biggest insured losses that in history, superimposed on today's demographics. And importantly, we only have data on about 250 years of hurricane losses. And importantly, the denominator is much larger than that. Maybe not infinity, but certainly it's more than 250. So we can't expect to already know everything that's going to happen or have seen everything that's going to happen. So my premise is that we could have a very large loss, and you may be able to tell that this is where we've gotten a lot of pushback in our papers. How are we able to have a loss that big? Well, here's what Karen Clark says. And she was one of the first people to come up with these catastrophe models and put out as part of her deterministic model. This is a scenario where a Cat 5 hurricane comes to Miami. leaves it in shambles, picks up speed over the Gulf, and hits Houston, and that's about $850 billion. That's all of the capital that the insurance industry holds, roughly. And so if we've got something like that happening, this is how it's likely to pay out in terms of the 45-degree line is the total amount of the loss going across the x-axis and how much is actually paid. And this line here is where we estimate after insurance companies become insolvent. And then the second line being how much the guarantee fund can pay, because they're limited to somewhere between 1% and 3% assessment on the surviving insurers. And so you can see that that's not going to be satisfactory to a lot of people if we have a really large loss. And what we can, because this is just the first year, this is what's paid in the first year. And what we can expect is a federal solution. What we learned from COVID is that the feds can just have a helicopter show up and dump Benjamins on everyone until we inflate everything in the economy, and they very well may, but at what cost? And I would argue that at what cost is we go from having this federalist type system of insurance regulation where we have 56 distinct jurisdictions, and a lot of people think this is quite a good thing. I suppose that the devil's bargain in getting that bailout is that we would go to having one regulatory jurisdiction. Now, maybe I'm a conspiracy theorist about this, but it wouldn't be the first time that folks in DC have assumed that they could do a lot better job. And honestly, some people in the states have agreed with them. I don't count myself in that group, but also nobody really cares what I think. But I think that's something that's certainly a consequence that we want to think about. There's also the $35-ish billion a year in insurance premium taxes, which are a sales tax that is in many states the largest contributor to a state's general fund in terms of taxes. So what do we do in this paper? We take some papers that were looking at how can the insurance industry pay for a really big loss back in the 90s after Hurricane Andrew. And we revise that a little bit, and we throw in this new wrinkle of guarantee assessments, guarantee funds, and we propose policy solutions. There are a few things that we plan to do to improve the methodology a bit, but we'll get into that if we have time. This is a paper that we followed, or we began following, by Dave Cummins and Neil Dorey and Ada Lowe from 2002. Their paper is this clever and elegant solution to how do you divide up the losses across insurance companies based on how they've responded to losses in the past. And I say if their paper is the elegant weapon of a lightsaber, that ours is like a rusty pocket knife. We take a much more direct route to estimating it, but in reality, I don't have a very useful lightsaber at home, and my rusty pocket knife is used on most weekends, so maybe we are onto something. I don't want to go into too many details about guarantee funds because there's a lot of them, and there's a lot of information about them out there, but they exist to step in when an insurance company goes insolvent. There are a lot of rules. This might be the wrong crowd to make this analogy, but if you've ever been to the state fair and seen the little kids rodeo where they're riding sheep and goats, it's about as organized as that and as expected. There's a lot of things about each guarantee fund that's very different from every other guarantee fund. And in fact, the main things we look at are the limit to claim payouts. You can see each one of these we have a diagram for, where the limits go from 100,000 up to 5 million, with the most common being a $300,000 limit per claim. The way that assessments are capped at 2% of premium written in the previous year, but it varies from 1 to 3. And of course, one state, one we're in now, has a pre-funded guarantee fund. And then the number of accounts. So accounts are especially important. So I'll dig in just a little bit, but you can see but we're already getting enough details moving around together that you're kind of playing chess with stock and have to make sure you, at least for my slow brain, I have to think about this pretty carefully and slowly. But the different accounts, some states just have one account. The account depends on who's going to contribute to the losses from an insolvent insurer. So if it's one single account, it's every insurer in the state, no matter what types of insurance they write, but many of them are different based on if you write workers' compensation, auto versus all other, auto plus homeowners versus all other, and maybe something separate for title insurance, fire and allied bonds insurance, and maybe a separate account or a separate guarantee fund for domestic mutual companies. So based on all of these rules, we based on all of these rules, we code in just a big matrix of how these losses are going to be handled when and who's going to be paying in when losses happen in a given state. I also note that there's recoupment rules for guarantee funds that range from being allowed to increase your rates down to having a premium tax offset where you can write off the guarantee fund assessments against your premium taxes over 5 years. Importantly, the rate increase only exists in a competitive market where you might not be able to take the entire rate increase if there's other insurers that aren't taking it. And some of the evidence that I've seen shows maybe you get 30 or 40% of that if you're in a state that has a robust and healthy insurance market. And then the policyholder surcharge is kind of what Florida does, where they put a surcharge on every single policy in the state except for workers' compensation and medical malpractice, and you actually see it on your insurance bill. We also think it's important to think about this insolvency assumption when most of the capital in the insurance industry is at the group level. And if you assume that groups do not let their affiliates fail, then you get a much different answer. Although the behavior makes it look like, so I don't think that State Farm could let its Florida affiliate fail and still continue to do business like a good neighbor, right? There might be some real high cost to that reputationally, but then, and perhaps the reason why they do have separate affiliates is you'll notice those separate affiliates in many cases have separate AM Best financial strength ratings. And that's, so they do that to so they don't have to put all of their capital in one state. So here's the difference, the bottom line being the individual companies and how much they can pay out versus the groups of companies if they are required to help each other. You can actually observe a good bit of this in their schedule, one of those schedules, and Schedule F in their filing, where you can see all the pooled reinsurance. That some of them do make this promise explicitly, they will support their group members. So the last thing, the last part of our paper is how we divvy out the losses, the exposure to each state. Now, like I said, the Cummins et al. Has this. Oh, I just saw some frowns come on. But some people are smiling, but there's some frowns that you think I don't even know what most of these things are. But this is the process that Cummins et al. Used to. They use a system of regressions and an assumption about a jointly normal distribution to determine how to allocate losses across insurers. And there's a big hurricane. And what we use this for is to check and make sure that our way works pretty well. What we wind up doing, this is still in the paper right now. We're gonna talk less about it because it just doesn't work very well at the state level. It makes everything sum up to like a Borsch equilibrium at the national level, which doesn't exist at the state. So what we use is the premium method. We take the share of premiums written by each company in each line of business in each state, and we distribute the losses based on premium share. Now this ignores potential underwriting heterogeneity that a company, say Farmers might write a lot of business in along the Gulf Coast, but not very much right on the Gulf Coast. I'm just picking that name out of the air. I don't know if they do that or not, but most of these states have a win pool or a fair plan that imposes this market share exposure for the greatest risk, because when the win pool or the fair plan runs out of money, then they send out assessments, much like the guarantee fund. So that's how we're different. We can't explicitly control for reinsurance, although I'm starting to think maybe we can. I have some ideas on how to do that. It'd be a very ad hoc basis. But what we can do is look at the state level and study guarantee fund performance and what happens. So we make a couple more assumptions. Insurers are insolvent when they run out of surplus. Remaining losses are owed by the guarantee fund through other companies' surplus that are in the same account and the same state as that company. And that guarantee fund assessments are limited by the percentage of premium written and account rules. So in other words, we stick it into one side of a very complex matrix and machine that comes out the other with our answer. And this is I believe this is our most recent showing of how much is paid in the first year, which is still very telling. Once you get up to 100 and something billion, you're starting to see some companies fail and some amount not being able to be paid immediately without some sort of intervention. The average time to full payment, this is across all the states, it's really steep here over about 800 billion, which is, there's a very small chance of that happening. But who wants to wait 80 years for their insurance premium for their insurance claim to be paid? That's not acceptable to lenders. It's not acceptable to policyholders. And it would cause a lot of problems throughout our economy, and wrecking essentially the entire insurance industry. And also we can show how much is paid out. That's kind of, it winds up being that in the last several years, State Farm and Berkshire Hathaway are the only two left with any money, and they pay out 2% of their previous premium for a long time, and we assume that they don't die. They have something like 40% of the industry surplus. So what happens? Well, you have unpaid losses that are bad. We talk about having a guarantee fund death spiral, wherein a new company could come in and not be subject to these assessments. And what I'm told is very recently that is less likely to happen than we had assumed. I know that Florida has a law that specifically prohibits it. I know that when I ran an insurance company, we were new and we didn't have to make any guarantee fund payments. So I was assuming that nobody else did either, but this is maybe less of a thing. But if that were true, it could cause a death spiral, in that all the companies that have to make these assessment payments are losing their market share because their premium is too high. And then we would wind up with some federal regulation. So what could we do? And this is the most important thing about this work. The first thing here is prearranged debt capacity. I'm told that after Hurricane Hugo in 1989, that even without legal authorization, the South Carolina Guarantee Fund was able to borrow money to pay claims for the companies that went insolvent. It took them about 5 years to pay that back, but they went out and borrowed it at the time. That's a very localized, Hugo was a very localized storm. In this much larger event or series of events where we could have a hurricane, an earthquake, and a wildfire within a few years of each other and come to the same thing, but having this prearranged debt capacity, perhaps from some of the government, some of the GSEs, the Freddie or Fannie, Federal Home Loan Bank, that has an interest in this, might want to make sure they have prearranged debt capacity, because borrowing this money from the federal government could have, or from directly from FEMA or another entity without arranging it in advance. This is the whole thing. If you go to somebody to borrow money when you really need it, that's the worst. That's the worst approach you can take. It's like showing up to an auto mechanic with your car on the back of a tow truck, and you're out of town. Right? Oh, we've got you. You've got to pay whatever we want. So having this prearranged, and Florida does In many cases, they've got legislation saying they're allowed to, and they have the full faith and credit of their state treasury available to borrow money to pay for these things, to keep up with the assessment, or to pay all of the losses in the first year, and then let the guarantee fund payments and assessments pay off that debt. So a relatively simple thing. It might require legislation. It wouldn't necessarily be state legislation that would be hard to pass. I don't think there's a natural opposition to it to make this a bit safer. To the extent that you can, and I'm questioning whether you can or not, but if you could have this competition problem with a new company not having to make 2% assessments every year, then which would affect competition in the state. What Florida does is they charge a tax on all companies that's equal to some minimum amount or what they wrote the year before, so that you don't have these competition problems. And the last thing to think about, I'm not aware of there being these laws in place, and I don't even know if they would be socially optimal or optimal in public policy, but we know that the outcome is much better when there's group support than for each company than when there's not. So maybe just looking at the contracts and making public these intra-group reinsurance contracts that do effectively require group support for and make all the group's capital eligible to be paid out in losses could make a big difference when you have this giant loss. And that's all I've got. Thank you.
Thank you, Lars. Great presentation. We do have time for a few questions.
So Lars, thanks for your presentation. So it seems to me that one public policy response would be to raise awareness. Thank you. Would be to raise awareness among the citizens of a state that if there was a bad loss, their state guarantee fund could go down. So for instance, Florida, maybe make people aware of that. Related to that, I think if a disaster like that did hit Florida, a lot of the banks would suffer because of people basically dropping off on their home loans. So I think somebody mentioned earlier today that perhaps interest rates should be sensitive to natural catastrophe risk, and that'd be another public policy solution to consider. And then since nobody else had any questions, another thing that caught my attention was that your doomsday scenario, I think, was a $1 trillion loss going from Miami to, I don't know, Galveston or Houston.
50, but yeah.
Yeah, okay. And I think somebody mentioned earlier today that insured losses were about 1/3 of total cat losses when they happened. So I was just wondering, are you actually talking about a $3 trillion loss there?
For economic value, it could be much higher than that. Any insured loss numbers that you see is usually, about 1/3 of the total economic loss, but maybe a lot less of a percentage for, say, an earthquake that's not very well insured, not a lot of insurance penetration.
All right, so you're basically predicting then a $3 trillion loss of a Cat 5 hits Miami, goes across the Gulf, and then hits Houston. So
yes.
Is that all right? Thank you. And I will be quiet now.
Just a quick question on the institutional design of these funds. Like deposit insurance, for example, is very different, is structured very differently. You have an ex ante assessment fee placed on the banks for the privilege of having, depositors be insured. And I guess I was just wondering why the ex post assessment of insurers was favored over an ex ante.
The idea is that the companies will monitor each other if they know they're responsible. There's not a lot of proof that it works that way, but it at least makes sense that it could. Rob.
Well, I was sort of intrigued this morning to see that the Citizens Fund had figured out a way of disposing of the risks that it was sort of targeted with. Have you seen other arrangements like that?
I'm actually now curious how Citizens has disposed of this other than to, put surcharges on all of their policy, on everyone that lives in the state, right? So it's.
Well, I mean, I think what they've done is they have sold the mortgage, these are the mortgages, mortgages to the, to Fannie Mae and Freddie Mac, who have guaranteed them, and therefore they've shifted the risk to the US government.
The asset side of their.
Oh,
balance
yeah,
sheet.
yeah.
The what?
On the asset side of the balance sheet, that's what you're talking about,
Yes, right.
but not the liability side, doesn't handle the liability.
Oh. So Citizens?
Is that what you're talking about, Rob? The
I'd-
asset side of the balance sheet, they sold their mortgage-backed securities. They haven't
Okay.
disposed of the liability that way.
I see. So they're still exposed to the,
They are. That has nothing to do with it.
So the banks have sold the mortgages to Fannie Mae and Freddie Mac. Citizens transfer the policy from their balance sheet to the demotech insurers.
Right. That's a.
Some of it, yeah.
That's a different story.
no, but I think that was, I don't know, maybe I'm confused, but I thought that Citizens had reduced its liabilities to these.
That's a different transaction.
So Citizens is doing the depopulation where they're transferring insurance policies from their balance sheet to private insurers is what you're talking about.
Right.
They're making this institutional arrangement. But my paper, a part of what we're talking about is they're transferring policies to private insurers that end up going insolvent, and those policies end up back on their balance sheet. So it's a very, it's not a great way to reduce fiscal risk.
Okay, well, I think my question is not
Is there a
relevant.
way- Question ought to be, is there a way
Is there a way?
to
Yes.
transfer the liability to somebody else?
At least the timing risk there is, and that's part of our policy prescription is to prearrange this potential debt so they can pay all of their losses in the first year that come through the guarantee fund.
What's the collateral for that debt, Lars?
It's the full faith and credit of the state of Florida.
There you
It's not- Yeah,
So it's the taxpayer.
So Lars, you're saying one solution, get to the question down front, to deal with those liabilities, one of your suggestions, I thought, was to let them go up to the group level.
part of it, yes.
All right, and of course, the danger of that, and which I would expect to happen, is a lot of the companies down in Florida that have set up a sub to insure in Florida would pull out at that
It
point.
could have
So that could
supply
well cause a
implications.
crisis right there in the Florida insurance market.
Yes,
We're
not
gonna answer-
disagree.
We're not going to answer all these questions but this is great. Now we're going to have a short break, and I do mean short, 10 minutes.